introduction. So my name is Jonathan, currently on the Strategic Initiatives Impact Investing team, and essentially I focus on the due diligence aspects of all the applications that come in. And so before the applications go onto Crowdvetting website, we get application inquiry, which is also known as a stage one. And from there, we kind of just do a quick overview of like where they are, what they're trying to do, and the amount of leverage they're trying to get. And from there, we determine whether or not to move them from stage one to stage two to get more in-depth analysis of their business. Once we receive the second application, the final application, I go back to the first stage one, reread it, and combine that background information, with the stage two, and kind of soak in what type of business they're doing, and to answer the first question, which is there social impact? And if there is a pretty obvious social impact, I would start digging a little bit deeper into the financials to kind of focus on whether or not it's a sustainable business model, and then go into why or the uses of the loan itself and whether or not this will help the company move forward in its growth. Each of those levels will prompt maybe follow-on questions. For example, if the social impact isn't very clear, you'll just we'll make a list of questions to be like, hey, what is your social impact? Sometimes if it's not clear at all, to like, can you speak further on the KPIs and how does this like big picture help out either the neighborhood or its community. And then for viable business, basically what we're really focusing on is whether or not the company has sales that can pay back not only us, but in the event of like all their debtors came to them and wanted their basically debts paid, so will the business still be there and survive in 12 months? So it's mainly when you look at the financials, you're focusing on the repayment risk. So we don't want to be in a situation where at the end of maturity, we want to collect on the loan, that they would have to liquidate maybe assets, and then the business just goes bust. So to avoid that, which is why we focus on more of a 30% leverage ratio. In terms of business benefits, will it benefit them? Like, what are they going to use it in terms of working capital? We definitely do not encourage that they use the loan to purchase like land or any type of property, but in terms of like helps them move day to day to get to the next level. For example, like buying a larger amount of inventory because of the lead time takes like a couple months, and they just need a surplus of inventory in order to capture a larger like commercial market of some sort. I start with opening both the inquiry and the final application and read it back to back. From there, I conceptualize the business, kind of figure out what it is. If it's the type of industry I'm not aware of, I'll start Googling and try to get more background to find more of a benchmark to compare it to. And then compare the financials to that business based on my understanding at the time and whether or not it's viable. So we normally want to do like a 30% leverage of assets or sales revenue. But for example, a like solar company, solar could have a large amount of assets. However, those assets may be tied into account receivables. So those account receivables may take upwards of 12 months to really realize as cash. So that poses an issue with our loan. So if they can't collect upon all their assets or the receivables, then they can't really pay us. So we want to see a good amount of revenue generation, so that at least those accounts receivables or converting accounts receivables to cash is a good amount or at a good percentage in order to make the monthly payments and or any of the negotiated terms of payment schedule. Following that, do a quick background check on the like board members, the founders, kind of see where they came from. Do they have industry knowledge, or did they just start, or do they have a good idea and just start running with it? In terms of funding, if it's like a impact investment, maybe go to that website, see who they've invested previously, to kind of find the different companies who back this particular applicant, to see their scale, legitimacy, and maybe even just reviews. If you have access to LinkedIn, you could LinkedIn the folks again and kind of see their timeline of how they got to where they got. And one kind of like sniff test is to see how developed their LinkedIn. So we'll have like some folks, LinkedIn has maybe a picture, some blank areas with like 5 connections. So then that kind of gives you not a very feel-good feeling. So you kind of want to just further strengthen the legitimacy of the folks that you find. So just really Googling and gaining more clarity. That's in conjunction of like referrals, any like personalities or organizations that is part of the application. You just pretty much Google it and LinkedIn search them. Just kind of get a better background, like investigation on them in a sense. Other companies that work for, how many people they connect with, the value of their connections. So if the founders connected to a really known impact investment company, and to kind of see how robust their networks are, almost in a way to validate that they're good people to work with in a sense. Also, like look into any awards they enter, or public or media coverage in a sense, like any big name brand media that did an article or story on them. 0 to? Really, I focus on the amount of cash flows, and then if I detect any like any oddities in the financials, then I would kind of dig a little bit deeper. Like anything that really sticks out or confuses you, or gives you a weird feeling, like that doesn't really make sense. I need to know the stories behind it. Maybe like there's a balloon liability that popped up. Like where did that cash come from? Who they owe? What are the terms? Or like for recently we've had negative retained earnings that really confused me in terms of like how to conceptualize how that was possible and why that was the case it was. And so kind of want to filter out any like essentially financial shenanigans. Although it's not an audited financial, it does paint a little picture and may provide you with a direction to follow up on. And what's important to me is the level of cash and cash flows, essentially. And will they have a runway of like 12 months or the tenure of the loan? Red flags is a lot of leverage. If you're saying like the company lists their initial funding activities were all debt financing, and they don't provide like a tenure or additional details, you might want to go into that because you want to see where on the precedence Kiva is in terms of being paid back. So if those debt financing mature prior to the Kiva's tenure, will they have enough cash after they pay everybody off to pay Kiva? You can look into some of the like really odd, like for example, negative retained earnings or negative equity. Like kind of dig into like what caused that and kind of hear the story behind that. Any areas in the financial that doesn't have details. Again, mostly it pops up in short-term liabilities, but occasionally long-term liabilities. If you see a large asset but you have a large receivable account, then you might want to dig into like, hey, like what is the company doing to try to like increase the collections of those account receivables, or is this normal? What's the expectation? A good balance with sales revenue doesn't necessarily need to be profitable, but a good amount of cash flows inwards that they're using towards either trying to buy more inventory, kind of low expenses. I would say, depending on the industry, I would like to see a lower accounts receivables. Like a lot of accounts receivables is kind of misleading for me because it does fall under the assets, but it's cash that the company doesn't have, but they book it as an asset. So it kind of is useless until they turn that into straight up cash to be used for whatever operational stuff that they need. So for me, the green light is good cash flow, and low expenses like any other business. Growth is another good one because we normally want at least 2 years of financial data, and that, even though if they're not profitable, but they show like increase in sales, and the stability in their expenses is still a good green light as well. These financials already are like unaudited, so all of them are, you take it with a grain of salt. So, and you got to understand a lot of the folks that we are partnering up with to finance doesn't necessarily have the background, or and there's sometimes is a language barrier in understanding how to fill these out. So again, take it with a grain of salt and evaluate the best you can, and just come up with your own projections in the sense of like how much weight you want to put on these numbers, and whether or not you feel that they are enough to sway you that Kiva will be paid back at the end of the day. So again, we're not looking forward to making money. We're just trying to get our money back in terms of like it's out there to be used as working capital to help grow that business, and we get paid back. So in summary, the way I approach the due diligence is to look at both the inquiry and the application, reread it to kind of get the holistic picture of it. Then from there, kind of go through the financials to see if it matches, if it makes sense. Throughout the whole process, I'm coming up with additional questions to follow up that either unclear to me, or I kind of just follow on questions. Following that, if everything seems to make sense and is in line, I'll dig a little bit deeper into the company's media coverage, the referrer, the founders, all the personalities essentially, and to make sure that this whole story all is consistent in a sense. And from there, once I get a better grasp of just basically the whole picture, just follow up with the questions. And if the questions return back, or the answers that return back, give me a better confidence in the company itself, then we conclude our due diligence and we send it to the risk team for additional follow-on questions or gaps that I've missed.